Welcome to this special IPO Analysis Explainer. I'm really thrilled to guide you through this today. We're actually stepping away from our usual format for a moment, simply because right now, the primary market is throwing an absolute flood of opportunities our way. My goal today is to help you navigate this rush with total clarity. We're taking expert analysis from HIM Securities' senior research analyst, Asta Jain, and we are translating that directly into actionable strategies for you.
All right, let's dive right into this crazy contrast we're seeing. Over on the left, you can see the secondary share market is stuck in this sluggish 4-day slump. But look over on the right, the primary IPO market, it is absolutely buzzing. We've got 5 major events happening literally right now. 3 fresh issues opening, one that opened up yesterday, and a massive listing coming up tomorrow. There is absolutely money to be made here, but you've got to have a roadmap.
And here is that roadmap. Today's agenda is going to cover a quick market overview. Then we'll look at why you should stay away from cube highways. After that, we'll check out the middle ground options of Lohia and extranet, dive into the absolute star of the show, Indo-MIM, give you a playbook for Caliber Mining's listing, and finally, a survival guide for SBI funds.
Section 1, Market Overview, Finding Alpha in the IPO Rush. We really need to start by contextualizing the current market mood, right? Because this context is absolutely crucial for deciding whether you should be booking quick profits right now or holding these assets for the long haul.
Moving to our first specific asset, we have Section 2, Cube Highways, Stay Away. Let's look at exactly why this massive 5,000 crore issue is just failing to impress.
So what's really interesting here is the underlying structure of this asset. They're operating in the 151 to 152 rupee price band, and they've got this super hefty 14,440 minimum lot size. But the key is that Cube Highways is an INVIT, an infrastructure investment trust. Now sure, it boasts a predictable cash flow, and it's one of India's leading highway investment trusts, but because it's an INVIT, it structurally lacks standard retail participation. You basically only have institutional and other investor categories playing here. And historically, these kinds of instruments just struggle to attract broad market interest, and honestly, this one is proving to be no different.
And that leads us to this brutal number right here, 0.05 times. That is the dismal overall subscription rate on day one. Even though the non-institutional investors subscribed 11 times over, the qualified institutional buyers, the real heavyweights, they were completely absent. The gray market is showing absolutely zero enthusiasm for this.
And the core structure of this deal brilliantly illustrates why they're staying away. This entire 5,000 crore issue is a 100% offer for sale, or OFS. That literally means not a single rupee of fresh capital is going into the company to grow the business. It is all just going straight to the existing sponsors. So given that lack of institutional interest and the sheer number of better IPOs currently floating around in the market, the expert verdict here is a very firm avoid.
All right, moving on. Let's see how this builds our strategy by looking at Section 3. Lohia Corp. And extranet tech, the middle ground. We're looking at 2 totally different companies that actually land on the exact same investment verdict.
Let's compare them side by side to see what's going on. Over on the left, Lohia Corp is an 1,100 crore issue, completely OFS. They are an absolute global giant in machinery for technical textiles, specifically jumbo bags. They hold a massive 40% market share in India and 15% globally, exporting to over 90 countries. But they are coming in at a slightly high price-to-earnings multiple of 23. Right now, the gray market premium is hovering around 8.5%. Then, on the right, we have extranet tech. Much smaller at 167 crores, but hey, it's a 100% fresh issue. They provide IT and cloud solutions to the government, PSUs, and railways. Their valuation is a much more comfortable 18 PE, and their gray market premium is sitting around 10%.
But you've really got to keep this warning in mind when you're looking at extranet. Because its issue size is under 250 crores, you have to expect heavy price swings on listing day. It could list way higher or way lower than what the gray market suggests, simply due to its small size and all the volatility that brings.
Ultimately, for both Lohia Corp and extranet tech, the expert strategy is crystal clear. You can either subscribe to take your modest listing gains and run, or, if you really believe in their respective business models, strap in for a long-term hold.
Now we'd arrive at Section 4, Indo-MIM, a fantastic opportunity. This is, without a doubt, the star of this explainer today.
Okay, so this is a massive 3,800 crore rupee issue operating in the 461 to 485 price band. And yeah, even though 3,300 crores of this is OFS, the business model itself is incredibly attractive. They make precision-engineered components. We're talking highly complex, small mechanical parts where liability is everything. They use an advanced metal injection molding technology that requires immense capital and technical know-how. That creates massive entry barriers. But here is the absolute kicker. They are India's only pure-play company in this sector. They compete on a massive global scale, primarily going head-to-head with a Chinese-listed firm named Jianzhou Jian. Because they are literally the only ones doing this at this level in India, they enjoy a massive scarcity premium.
And let me tell you, the gray market recognizes this. It is going absolutely wild with an expected 38% premium. That means it could list around 672 rupees, which is nearly 187 rupees above its higher band. Now you might hear their 44 to 45 PE valuation and think, wow, that sounds high. But when you actually compare it to the financials of their Chinese competitors, it's highly reasonable.
Because it's a large size issue, which, gives you much better chances of an actual allotment, combined with those stellar fundamentals, the verdict here is a resounding, strong subscribe. It's just a fantastic bet, whether you're looking for immediate listing gains or you want a really solid addition to your long-term portfolio.
All right, let's pivot over to Section 5, Caliber Mining Listing. This one requires a bit of listing day preparation.
The institutional demand here perfectly explains why the gray market expects a 19% premium, pointing to a listing above 500 rupees. For some context, this is a 450 crore issue set to list tomorrow. Their absolute standout feature is a phenomenal order book that's already sitting at 4 to 5 times their projected FY26 revenue. Basically, the company operates mines rather than owning them, and they plan to use the fresh issue funds to aggressively reduce debt. While the retail portion was oversubscribed 41 times, just look at that institutional demand. Qualified institutional buyers subscribed a staggering 240 times over. The big money really wants in on this one.
So here is your exact playbook for Caliber Mining's listing day tomorrow. Step 1, if you're lucky enough to actually get an allotment and it lists above 500, protect your capital by booking partial profits early. The overall market mood is kind of weak right now, so play it safe. Step 2, if you missed out on the allotment, do not chase the stock on listing day. Just patiently wait a few days for the volatility to settle down. And step 3, if you want to make a fresh entry, only do so on dips over the coming days. Finally, we move to Section 6, SBI Funds. What now? This is your post-listing survival guide. We have to address a recent listing where the harsh reality severely disappointed investors' sky-high expectations.
You really have to consider the brutal contrast between expectations and reality here. The gray market was anticipating a 17% premium and a listing near 670. Instead, it kind of limped onto the market at 613, gave a very brief high of 625, and then totally crashed back down, closing below the 610 stop-loss level on day 1. By July 22nd, it had tumbled to 583, hovering perilously close to its 574 issue price. Why did this happen? Well, it was a combination of an incredibly large issue size, which makes those high percentage pops really difficult, and a very weak secondary market sentiment that just dragged the whole thing down.
So if you are stuck holding SBI funds from the IPO and you just watched your expected gains get totally wiped out, here is your survival guide. First things first, do not panic. The expert analysis strongly recommends holding your position. Second, you need to extend your timeline. Wait 3 to 6 months for the true value of the business to be realized. And third, if you hold, the projected recovery target actually sits pretty comfortably between 650 and 700 rupees.
But what if you're watching this and want to make a fresh entry now that it's cheaper? Hold your horses, do not rush in just yet. Wait for the dust to completely settle on this price discovery phase. Your target should be to buy near or even slightly below that original 574 rupee issue price once the market sentiment really stabilizes.
As we wrap up this special explainer, I want to leave you with something to really think about. Look at your own portfolio right now and ask yourself, are you just chasing the thrill of quick listing gains, or are you strategically allocating capital for long-term wealth? Know your risk appetite, stay totally disciplined with the data we covered today, and keep exploring the fascinating mechanics of this primary market. Thank you so much for joining me, and I'll catch you in the next explainer.